Okay, let's unpack this. We've all heard the whispers, haven't we? That real estate is the secret pathway to wealth, a non-negotiable for the financially savvy.
Right.
But, I mean, in an age dominated by AI, crypto, all this dizzying tech, is building an empire with bricks and mortar still relevant?
Yeah.
Or is it just, an old school myth that stubbornly refuses to die?
Well, what's truly fascinating here is that the core principles, they really endure, maybe even strengthen, actually, in our rapidly changing world.
Interesting.
Yeah, our source material, Real Estate Investing for Enduring Wealth, it doesn't just suggest it still works. It presents a pretty compelling case for why it might be more crucial than ever.
Okay.
So our mission today, let's cut through the noise, distill the truth, maybe highlight some surprising facts, and give you the essential nuggets of knowledge to approach real estate investing with genuine confidence.
That's right. We're diving deep. Not just why real estate remains a favorite for enduring wealth, but really how to navigate its complexity. We'll look at the undeniable strategic benefits, sure, but also confront the very real challenges. And hopefully offer concrete steps for getting started smart without feeling overwhelmed or, critically losing your shirt. We're going to explore what the wealthy seem to understand about this asset class and what you absolutely need to know before you even think about making your first move.
Sounds good.
So let's jump straight into the why. With so many other investment avenues being so volatile or purely digital, what makes real estate such a magnetic, sort of long-term play for serious investors, even now?
Well, if we connect this to the bigger picture, it really comes down to a few fundamental, almost primal reasons that just don't change.
Okay.
The first, and arguably the most foundational, is what our source calls the AI-proof nature of shelter.
Ah, AI-proof. I like that.
Yeah. I mean, think about it. AI is revolutionizing industries like crazy writing, coding, analyzing everything. But it fundamentally cannot replace the physical demand for a roof over one's head, or a space to conduct business for that matter.
Right, it's basic.
It is. And this isn't just about needing a home. It's about real estate providing a kind of anchor, a tangible hedge against all the volatility and digital abstraction dominating other investment sectors. It makes it genuinely resilient.
That's a powerful point. Very timely, too. It's a basic human necessity. AI can't just code away.
Yeah.
But, okay, beyond shelter, what other powerful draws does real estate offer? What's the next big appeal our source highlights?
Right. So beyond that foundational need, the concept of passive income is, well, it's a huge draw for almost any investor.
The dream, right. Earn money while you sleep.
Exactly. The material highlights that by strategically setting up systems, maybe hiring a property manager, your rent payments can consistently cover the property's bills and potentially leave a healthy profit. It's an asset that, once it's set up correctly, generates income for you, even when you're not actively working on it yourself. That frees up your time for other things and really contributes to that dream.
And unlike, say, crypto or even stock sometimes, there's something incredibly reassuring about owning something tangible, something you can actually see and touch. Drive by it.
Yeah, this raises that important question about security and tangibility that honestly a lot of investors value deeply.
I get that.
The research notes that unlike a share of stock or a crypto token, real estate is physical. You can see it, touch it. And for many investors, that gives this profound sense of control and stability, a grounded feeling that purely digital assets often can't quite provide. It anchors your portfolio in something real.
Okay, so tangible, income generating, but then our source points to some really powerful financial advantages, things that can dramatically impact returns, especially on the tax side.
Oh, absolutely. The tax advantages are truly significant. And honestly, they're one of the less discussed but most impactful reasons for real estate's enduring appeal.
Okay, tell me more.
First, there's depreciation. It's often called one of real estate's kind of stealth tax advantages.
Okay.
Yeah, our source clarifies this, lets you legally deduct a portion of your property's value each year as an expense against your rental income.
Even if the value is going up.
That's the critical insight.
Yeah.
Even while the property's market value is actually appreciating, it effectively creates a paper loss that lowers your taxable income, but without a real cash expense hitting your bank account.
Right.
It's a key reason why many profitable real estate investors can still significantly reduce their tax burden.
Okay, that's huge. What else?
Then there's the 1031 exchange. This is a more sophisticated strategy, but really powerful.
Right.
It allows you to sell one investment property, then purchase another property of equal or greater value. And here's the crucial part, defer paying capital gains taxes on the sale of that first property.
Defer. So not avoid, but push it down the road.
Exactly. And you can repeat this process again and again, potentially over decades. You keep deferring those taxes, allowing your equity and wealth to compound much faster, uninterrupted by those immediate tax hits.
That sounds like a major advantage for long-term building.
They aren't minor perks. They are significant strategic advantages.
Okay, so we've got the essential nature, passive income potential, tangibility, those big tax breaks. But crucially, this isn't some fleeting trend that could just vanish next year, is it? It feels more solid than that.
Precisely. The final point our research really reinforces is its time-tested nature. I mean, for centuries, right? Across different economies, political shifts, tech eras, people have used real estate to slowly and steadily grow and preserve wealth.
Yeah, it's been around.
It's a proven method, a generational wealth builder. Definitely not a speculative get-rich-quick scheme. It demands patience, strategy, sure, but its track record speaks for itself. It offers a resilience many newer asset classes just haven't demonstrated yet.
Okay, that all paints a really compelling picture. Almost sounds like a smooth ride to financial freedom. Buy a place, kick back, watch the money roll in. But the material isn't shy about the, let's say, stark realities either. It's definitely not just buy and relax, is it?
No, not at all. And this raises that important question about expectations versus reality.
Right.
While the benefits are undeniably clear, the source cautions strongly against a naive or overly optimistic approach. First, it explicitly states it takes work.
Okay, what kind of work?
Real-world stuff. Property maintenance, dealing with unexpected repairs, they always happen, navigating difficult or, frankly, bad tenants. Even carefully planned deals can, and often do, fall through. It's not always set it and forget it unless you have really good systems in place, and even then, there's some level of active oversight required, even with a property manager. The glamour often hides the grunt work.
Right, so it's not entirely passive without that manager, and even then.
Yeah.
And what about money? It sounds like you really do need some capital to get started, despite what some gurus might claim.
Oh, absolutely. The material is very direct here, provides a necessary dose of reality. It says, quote, you need some money.
Plain and simple.
Plain and simple. It specifically warns that those no-money-down deals, while they sound incredibly attractive,
Very tempting.
they are inherently risky. Now, creative financing options do exist, but trying to start with zero capital often means much higher risk profiles, less favorable terms, maybe significantly higher interest rates.
Right, you pay for it somewhere else.
Exactly. Building real wealth takes capital, even if it's modest to start, just to create a solid, resilient foundation. Chasing those zero-down deals can often lead to being over-leveraged and finding yourself in a really precarious position.
Okay, so the no money down, no problems fantasy is out. What about the pressure to find the perfect first deal? I imagine our source has some caution there too, given that we're all, human.
Absolutely. The source doesn't pull any punches on this. It says, you'll make mistakes. Every investor has a bad deal.
Every single one.
Every single one. And frankly, if an experienced investor tells you otherwise, they're probably selling something.
Fair enough.
The real insight isn't about somehow avoiding mistakes entirely. That's impossible in anything, let alone investing. Rather, as the material emphasizes, it's about learning to adapt quickly, to pivot, and ultimately become a more resilient and knowledgeable investor through those experiences. It's just part of the growth curve. You learn, you adjust.
Okay, that makes sense. Learn from it. Don't let it stop you.
Oh.
So we've understood the compelling why and acknowledged the very real buts. Now, for the crucial part, how do you actually start smartly without, losing everything? Our source lays out a clear, actionable playbook here.
Yes, and what's great here is that the material moves beyond just general principles to really practical steps you can actually implement. It boils down to 3 core areas you absolutely need to get right.
3 core areas. Okay, what's the first one?
The first key factor, and it's a classic for a reason, location matters most.
The old adage, location, location, location. The research says you can fix a house, but you can't fix a bad area. So if that's truly paramount, how do you actually find a good location? What are the practical steps?
Right, it's the bedrock. And the source offers very practical, on-the-ground research methods anyone can use, not just theory.
Okay, like what?
First, try the coffee shop test.
Coffee shop test. Okay.
Yeah, it's more than just ordering a latte. Engage with the local baristas, maybe small business owners nearby. Ask them, is the neighborhood improving? Are more people moving in or out? They often have this invaluable organic pulse on the community's direction. Stuff statistics might miss.
That's clever. Real boots on the ground intel.
Exactly. Second, Visit City Hall. Go inquire about future zoning changes, planned parks, road projects, new businesses slated for development. These kinds of public and private sector investments can significantly raise property values, attract new residents. They signal future growth.
Good thinking. Look ahead.
And third, use online tools. Things like Google Trends or census data. Check if the city's population is growing or shrinking over time. Generally, a growing population reliably equals more housing demand, and that supports property values and rents.
Right, follow the people. Okay, that's incredibly smart, combining that on-the-ground feel with the forward-looking data. But it sounds like this isn't really a solo sport, though. The material strongly emphasizes building a team. Who are the essential players you need?
Yeah, definitely not a solo sport if you want to do it efficiently and manage risk. A good team makes everything easier, reduces your personal workload, your stress.
I'll bet.
The research identifies several non-negotiable roles. You'll want a reliable property manager. They handle tenants, collect rent, coordinate repairs. That's crucial for actually achieving that earn money while you sleep goal.
Frees you up.
Totally. An inspector is vital. They find hidden problems before you buy. That can save you from potentially catastrophic, costly surprises down the line, turning a seemingly good deal into a financial black hole.
Oof. Need that.
A licensed contractor ensures any work is done safely, to code, legally, protects your investment, prevents future liabilities. An astute accountant is indispensable. Helps with taxes, understanding depreciation, strategically maximizing your returns. And finally, a good real estate agent, especially one who specializes in investment properties. They can be gold. They find deals, negotiate for you, often have access to off-market opportunities you wouldn't see otherwise. Saves you time, potentially finds better deals.
That's a solid team.
Boom.
Team set. Location is picked with precision. Now, the brass tacks, the money. Our source insists on knowing the numbers, really knowing them, to avoid losing money. What are the key calculations?
Right. This raises that important question. How do you actually assess profitability? Not just guessing or going on gut feeling.
Yeah, need the facts.
The source provides two critical metrics every aspiring investor should master. The first is net operating income, or NOI.
NOI.
Okay. It's straightforward, simply the rent minus the expenses. But importantly, this is before debt service, like your mortgage payment and income taxes.
Yeah.
It tells you the property's pure operating income, how well the asset itself performs.
Got it. Rent minus operating expenses. What's the second metric?
The second is the capitalization rate, or cap rate. This helps you compare different properties. It's calculated as NOI divided by the property price.
NOI divided by price.
Right. It gives you a quick snapshot of the property's unleveraged return, how much income it generates relative to its cost.
Can we walk through an example, maybe the one from the source?
Yeah, absolutely. Let's make it concrete. Imagine a property with rent of $1,500 per month. That annualizes to $18,000 per year.
Okay, $18K annual rent.
Its operating expenses are $6,600 per year. So the net operating income, the NOI, is $18,000 minus $6,600, which equals $11,400.
$11,400 NOI.
Right. Now, if the property price for this asset is $200,000, then the cap rate is the NOI. $11,400 divided by the price, $200,000. That gives you 0.057 or 5.7%.
Generally, the source advises a higher cap rate suggests a potentially stronger return relative to the property's costs. However, and this is a crucial nuance for informed listeners,
a very high cap rate can sometimes signal higher risk. Maybe it's the location, the property condition, market instability, something.
Okay. So it's not just about chasing the biggest number.
Exactly. It's about understanding what that number signifies in terms of market dynamics and aligning it with your personal risk appetite and long-term goals. It's a tool for comparison and analysis, not just a standalone indicator of a good deal. You have to look deeper.
That makes a lot of sense. Context matters.
Yeah.
Okay, so wrapping this up, what does this all mean for you, the learner, looking to build enduring wealth? We've seen real estate isn't some magic bullet, won't make you rich overnight. Definitely requires work, smart decisions. But it's absolutely not outdated either, is it?
Not at all. If we connect this back to the bigger picture, the material consistently reinforces that if you're smart, diligent, patient, methodical, real estate absolutely can build long-term wealth that truly lasts. It really is about informed decision-making based on solid numbers, building that trusted team, and having a strategic long-term mindset. It's not about chasing quick wins or, succumbing to speculative hype.
A powerful message. Honestly, it feels less like a gamble and much more like a carefully constructed, achievable plan when you approach it with the kind of knowledge we've discussed today. Thank you so much for joining us on this deep dive.
My pleasure.
And as you reflect on what we've covered, here's a final provocative thought for you. Considering how real estate is a physical asset and time-tested in this increasingly digital and fast-paced world we live in, how might embracing its tangible, long-term nature maybe change your perspective on instant gratification in other areas of your financial lives? Something to think about.